Hi, this is Ian Gendler, Director of Research at ValueLine. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted times for question and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on ValueLine.com and our YouTube channel within the next 48 hours. For those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I feel it's important to start with an update on the current economic environment. This content was created by Harvey Katz, ValueLine's chief economist. The economy continues to move ahead at a reasonable pace, with mostly hits and just a few misses along the way. To wit, recent weeks have seen a drop in jobless claims, a surge in housing starts, solid increases in existing home sales, uneven gains in retail activity, but slight downticks in industrial output and factory usage. All of this is consistent with a 2 steps forward, 1 step backward pace of economic growth in place through much of 2019. We think this will be the pattern over the next few quarters. Looking back on the modest business strides made in 2019 and the similar outlook in place on the consumer and industrial fronts this year, we think the past will be prologue in 2020. True, weather always is a concern early in the year, and this first half will have the added burden of the suspension of Boeing's 737 MAX 8 production. So we may see a slowing in growth in the first 6 months. Still, given the confidence associated with record high stock prices, the steady rise in personal income, and the high level of consumer spending, it is likely that GDP growth will move back into the 2% range by mid-year. Meanwhile, business sentiment should be aided by the thaw in trade relations with China. That is because the mid-January signing of a limited understanding with that nation will help our dairy farmers and beef producers, as China will be stepping up purchase of U.S. agricultural products. We also sense businesses may get a psychological lift as new tariffs are no longer planned. But more substantial changes in trade policies, which could make a larger and more positive impact on the business outlook, will take longer to achieve. Earnings are proving supportive as well, with about 70% of the companies in the S&P 500 posting positive earnings surprises, as results mostly come in better than forecast. It is little wonder that records have fallen again on Wall Street, with the Dow Jones Industrial Average rising past 29,300, the S&P 500 ascending to 3,300, and the NASDAQ surpassing 9,400. That said, due to health concerns related to the spreading of the coronavirus and its potential impact on the global economy, the markets, at least temporarily, have taken a step back from their highs. In conclusion, for now, we see little ahead that would cause us to alter our largely positive market outlook. We can use Harvey's comments and outlook to create an investment strategy. Thankfully, Value Line provides the tools to put this in action, which I will demonstrate when I get to the screener. Before we start our search, please note that I am already signed in as a subscriber and on the Value Line dashboard. From here, I can access all of the products, as well as view daily market commentaries, economic information, as well as general interest articles written by our analyst team. As you can see for today, we just recently posted an article about the interest rate decisions by the Fed, as well as several key earnings reports. For instance, Apple reported last night, and we heard from McDonald's, Dow, and Boeing earlier today. We'll also hear from Microsoft later this afternoon. Regardless of whether you're a subscriber or not, we recommend that you come to our homepage to read this important information. Let's now start our search for a worthwhile investment candidate. For this, I'm going ahead to the screener, which can be accessed via the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's focus on several details that Harvey mentioned in his report. To repeat his conclusion, for now, we see little ahead that would cause us to alter our largely positive market outlook. Obviously, we are rather bullish in regard to the near-term prospects of the market. Thus, let's generate a list of stocks that will likely perform well over the next few months, without taking on excessive risk. First, let's address quality. While we hold a positive view, there are still some concerns, including economic conditions and the spread of the coronavirus. Thus, I'm going to weed out risky equities so that we can indeed focus on quality. There are loads of risk measures out there, and the Value Line offers, but I'm going to focus on our time-tested safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. So I click on the safety rank field, and I want to focus on stocks ranked 1 or 2. These are the most financially sound companies that we track, and their stocks have a history of relative stability. As you can see, only 461 stocks in our database of more than 5,800 are ranked highly for safety. I now want to focus on equities that appear poised to succeed. Our popular timeless ranks should work well here. Like safety, the ranks range from 1, highest, to 5, lowest. Although the calculation is purely quantitative and proprietary, I can tell you that it includes a number of variables, including stock price momentum and earnings results. So once again, we click on the field, and I'm going to go with the 1s and 2s, since those are expected to outperform the broader market over the next 6 to 12 months. Once again, more information is available in our ranking system guide. For the next field, I want to further focus on potential upside. For this, I'm going to utilize a new feature from Value Line, and it is only available to our subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict the stock's price over an 18-month horizon in terms of a range. in addition to the high and low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely potential profit. The larger the percentage, the greater the possible price appreciation. The 18-month target price range is only available for the 1,700 stocks covered in the Value Line Investment Survey. We have also added the 18-month midpoint percentage to our online screener so we can use it today. For the midpoint, I'm going to set the low end to 20%. Thus, according to this measure, the most likely scenario calls for the following stocks to increase in price by at least 20% in 18 months. Admittedly, this is a rather aggressive percentage. Okay, 11 results, which is manageable. All of these stocks may fit nicely in a portfolio that is focused on short-term gains, without taking on excessive risk. With the help of several of my analysts, earlier today, we evaluated these stocks and chose to highlight J&J Snack Foods, ticker JJSS. Before I provide more information about J&J, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized stock report. Once you alter the presentation to your liking, you can save your changes from the sliding horizontal action bar. The next time you come to this report, it will look the way you set it up, and you can also apply these changes to other companies. Everyone may not be familiar with J&J, so let's get some basic information about the company from the Business Overview module. The New Jersey headquartered corporation manufactures nutritional snack foods and distributes carbonated and juice beverages mainly in the United States. It has 4,600 employees and a market capitalization of around $3 billion. Moving on, our digital reports possess a great deal of information and analysis, so let's take some time to look at details about J&J. From the valuation module, after a quick scan, shows that the company is trending in the right direction. In fact, sales, cash flow, earnings, and dividends are all moving in the right direction. Demand for J&J's offerings may well remain strong, since the movement toward healthier foods continues to pick up steam in the U.S. On that note, as mentioned earlier, it generates almost all of its sales from within the United States, insulating itself from any trade problems that may arise. At the top of our report, in the banner section, you'll notice that J&J's stock price still has room to run when looking at the 18-month target price range and our 3 to 5 year target price range. After advancing nicely for many years, it recently lost some ground following the release of unexciting December period financial results. We think that the pullback has created a good buying opportunity, especially for near-term investors. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available using the button here on the right. Let's see what our analyst has to say in the commentary. Many subscribers consider this the most important part of our reports. Senior analyst Kevin O'Sullivan stated the following: "We expect moderate growth in fiscal 2020. Our estimates call for the top line to rise between 2.5% and 3% this year. Earnings should advance at a higher clip, with cost controls aiding profits. Meanwhile, the quarterly dividend payout was recently lifted by 15%. Though the annual yield does not stand out, investors seem to clearly be able to bank on consistent dividend hikes from the niche snack food provider. Acquisitions will likely be in the offing. J&J management stated that it intends to use some of its cash to seek out merger and acquisition opportunities. It also did not rule out pursuing a large purchase, and from our view, finances should be adequate to pull this off. As for the stock, after a successful multi-year run, it has stopped to catch its breath. In fact, over the past month, it has declined about 10%. We think that this has created a worthwhile entry point. As such, we think JJSS is a standout for the short term and recommend that aggressive investors consider adding it to their portfolios. This marks the end of the formal presentation, and I will now tackle your questions. So please give me a moment to look through. All right. First question is, I believe your previous recommendation was Copart. That is correct. Since that recommendation, I've purchased it and I've had a 20% gain. Thanks. I appreciate that. Do you think this equity still has legs moving forward? Great pick. Well, let's take a look at Copart. Just a quick scan, and admittedly, I don't personally track Copart. It is still ranked favorably by our ranking system. However, it indeed has quite a run at over $101. It is now above our 3 to 5 year target price range and offers only a little bit of a gain to the midpoint of our 18-month. Just judging by those criteria, it may be a time to consider locking in some gains. But we did just put out a recent report. So let's see what the analyst has to say. We just go quickly to the investment advice. As we talked about, it's ranked to outperform. They've had a nice run of late. However, the upward trajectory has discounted the long-term earnings growth potential we envision. It may be best for just the short term. So on that note, obviously the price has done, if you look at the graph, it's been a phenomenal performer over the last few years. It may be a time to perhaps sell a portion of your shares and let the rest ride out. That's really a personal decision, but I'm glad the recommendation has worked out from a few months ago. Okay, next question. Is it possible to search for a supplementary report on a specific stock without scrolling through the entire chronological list? Can you change the list to alphabetical instead of chronological? Well, let's head to the dashboard and take a look. I will say while this is loading, you cannot change the order. However, you can search for a specific stock. For instance, me personally, I wrote the report on Boeing earlier today, and there's been several Boeing-related supplements of late because of the troubles with their 737 MAX 8 aircraft. So simply hitting Control F and searching for Boeing will bring up the latest report. And obviously this will work for any of the stocks that we have written about of late. I believe we keep 90 days worth of subs on the list. So just to prove you that it works, if I was searching for Masco, for instance, and it brings you right to it. But you cannot change the order. It's always chronological. Subscribers, I greatly recommend that you come to this section on a regular basis. It provides the most recent up-to-date information on the stocks we cover. as well as investment advice. As you can see, today being January 29th, we have been quite busy. And during earnings season, this is a pretty regular occurrence. Do I myself purchase these stocks you suggest? No, I don't personally take, it'd be a huge conflict of interest. So I do not personally take positions in any stock that I recommend. And as I mentioned earlier, the analysts are prohibited from owning any stock that they cover. Can you please explain buy, sell, and hold in the institutional decisions section? So we're referring to this box on our page. The numbers are in thousands, so that's a good thing to note for the holdings, and that's the total dollar value of shares owned. So there were 262 buys in the first quarter of 2019, 231 sells, and these are all by large institutions, and then the total dollar value of the holdings. I can't quite understand timeliness. Can you elaborate? Yeah, I'll go into kind of a quick dive, and then I'll show you where to find more information. So the timeliness ranks is our quantitative measure for how we think the stock is going to perform over the next 6 to 12 months relative to all other stocks that we cover. We think the 1s and 2s will outperform. The 3s will be average performers relative to the market, and the 4s and 5s will underperform. These stocks are plotted on a bell curve. So at any one time, there's only 100 1s and 100 5s, 300 2s, and 300 4s, and then approximately 800 or so 3s. You'll also have a lot of stocks that are unranked for timeliness because of short trading history, a recent large merger, or a corporate action that causes the stock to trade on something other than fundamentals. For more information, under investment education, and click on the guide section. We have a whole pamphlet based on the ranking system. So you can get more information specifically on timeliness and safety and technical and our other proprietary measures. Next question. I'm headed to the Orlando Money Show next week. Will Value Line be presenting? No, that is not on our calendar. We do a fair amount of presentations throughout the year, but that one is not on the docket. So I apologize for that. How do you evaluate a forward P of 31 for a slower growth company? Okay. I assume we're back to referring to Copart. Actually, what was offhand? I don't remember what J&J's PE was. Let me pull up that PDF. We'll take another look. Oh, okay. So both stocks, Copart and J&J, have what I would consider an elevated PE. Obviously, their stocks have done incredibly well of late to justify it. In this market where everything's at or near all-time highs, obviously a lot of stocks can trade at heightened PEs. And we think that it could be sustainable for a little while longer. Maybe not in 10 years will this stock, or 2 years, will this stock be trading at such a lofty valuation. But there's certainly a lot of momentum. With all the other metrics and our outlook on the market, we're less concerned about recommending a stock with a lofty PE. It really depends on what kind of market you're in. If we had more bearish concerns, admittedly, we probably would not push a stock with a 31 PE. Although if you'll notice, if you look at the relative, which compares this stock to all others in our under our coverage, you'll see that going back to 2016, J&J always trades at a pretty rich multiple compared to the broader market. So it always trades above the market PE. How can you look back to view recommendations for the past 12 months? I'm assuming you mean recommendations for this webinar series. All of these webinars are available via our YouTube channel. But just note that these one stock to buy right now, we do not provide follow-ups. So the first question we had was Copart was, a good performer since we recommended it, but I don't provide follow-up webinars on recent picks. When do you take into account insider selling? That's something the analysts, we always look at. It's not a bad metric to consider. If, your corner office is selling the stock, nice to know why. I will say in this market where everything is at highs, it may tell you not as much as usual. It could just be that, they have the shares and they need the money for something else, or that they're taking advantage of a high stock price or a hot market. It doesn't always mean that the insiders know more than the public and they think the stock price is going to go down and there's some kind of problem with operations. What criteria would you use for a more long-term investment, say 3 to 5 years? All right, well, if we take a look at J&J, because I've got the report right here, Value Line is one of very few research houses that actually provide estimates out 3 to 5 years. So our readers can get a pretty good idea of where we think the trajectory of the company is going when it comes to sales and earnings. And of course, we put out a 3 to 5 year target price range. So looking at our last report, and of course the stock price is a little bit lower than it is now, but we think J&J will trade between $190 and $235 out 3 to 5 years, which is not really that impressive. So this stock, for a long-term buy and hold investor, may not be that exciting. But as you know, we're looking for short-term gains today, and J&J fit the bill. But for long-term investors, I really recommend using our 3 to 5 year projections and our 3 to 5 year target price range. Are you concerned that JJSF has missed its earnings for the last 2 quarters? Well, as I mentioned, that their December quarter was nothing special, and it led to the stock price declining about 10% or so. So yes, I was concerned. I am concerned, but I think the price drop and where it's at now provides more upside. While it seems like most other things in the market are all trading at highs. I could easily recommend a stock that looks really, really expensive. But I think that the last quarter wasn't great, but the stock price reflected that, and now there's an opportunity. In regard to saved screens, there is a max. I think it's 15, but I don't know offhand, so I apologize. Let me see if there's any more questions. Hold on, please. Regarding the percent to midpoint for the 18-month target price range, some numbers are 20% and others are negative 20%. What's the difference? So it's exactly what it sounds like. For the stocks that are 20%, we think there's a good chance that the price will increase around 20% over the next 18 months. In turn, negative 20% suggests that the stock may decline by that amount over the 18 months. I subscribe to the paper reports. How do I upgrade to the full digital platform? Please call 1-800-VALUE line and speak to an account representative. Here's a Boeing specific question. What is your outlook for establishing a new position? We can take a look at the report I wrote today. For those of you, if you've spent this long on this webinar, you're probably very interested in keep track of the market. So you'll know Boeing's very public problems. Simply put, I wouldn't touch this stock at the moment. If you still own it and you've held it for a long time, maybe you want to continue. But they have serious issues. The stock may be prone to significant swings over the near term, and there's a lot of unknowns. So if you read my supplementary report, which is free on our dashboard, but here is my investment advice, and I know it's short, but I mean it. I just don't recommend the stock. There's too many unknowns. For most investors, unless you have a fairly high risk tolerance, I wouldn't recommend opening a new position here at this time. All right, hold on. There's several more questions. Do you interview company management as part of your investment research? Yes, the analysts are typically on the quarterly conference calls, speak to investor relations presidents and VPs. We are in touch with a lot of companies that we cover. I will say some don't want to speak to analysts because of danger of maybe saying something that isn't publicly known. But we do have interaction with management. How do you select stocks with high dividends and maybe price appreciation, but limited or no depreciation? I'm near retirement. So I could run a screen, high dividends and stocks that we think are going to perform well. But limited or no price depreciation, we can't guarantee the stock isn't going to go down. Even if you look at our ranks, which are relative to the market, a stock might perform well in a down market, but that doesn't mean it goes up. If you're near retirement, I would focus on high dividend yielding companies that are ranked 1 for safety, meaning they're the least risky. But there are always risks in stocks. So, I mean, we can go to the screener and do that quickly. So, as you know, the safety ranks were 1 and 2. I'm going to take the 2s off, remove timeliness, remove the 18 months. So, you're near retirement and you want dividend income. As you can see, only 126 stocks in our database have a rank 1 for safety. So these really are the largest, most healthy companies. And let's say you wanted a dividend yield of at least 4%, which is almost double the median that we cover. So only 11 stocks meet that criteria, and as you can see, it's a lot of household names. So for someone that wants an equity portfolio that is as conservative as it gets with dividends, this is what I would look at. We also have a product called Value Line Dividend Income and Growth that focuses on dividend-paying companies, not just the current yield, but also the dividend growth prospects. They tend to be large, conservative names, so that might be a product of interest. Should book value per share never be many times the stock price? This is actually a conversation the analysts and I've had recently. So a few years ago, and going back decades, book value was always, or I should say, was a popular metric to look at when evaluating a stock. You didn't want a stock that was too far out of its normal book value range, which was anywhere between, 2 times book value, or maybe slightly more if it's a very growth company. It's definitely taken a back seat of late. And that's because of aggressive share buybacks. You've got a lot of companies now. Home Depot comes to mind off the top of my head, which has bought back so much stock that their shareholders' equity and thus book value is negative. Boeing is another. So you can't use book value anymore to look at Home Depot or a lot of these stocks. The tax cut from a couple years ago, the corporate tax rate's now a lot lower, and a lot of companies have been using those proceeds to buy back stock. So as you can see, the shareholders' equity for Home Depot, was $12.5 billion in 2013, and it's now a deficit of $1 billion and change, which obviously makes book value negative, and obviously you can't compare a negative number to a stock price. So I personally don't take too much stock in book value anymore, at least not for all companies. All right, let me keep scrolling. Thoughts on GE? So as most people know, they reported, and I know the stock was up nicely today. And we did write a supplementary report today. I don't want to give too much away for free, but here is the information on GE. And for those interested, I recommend that subscribers take a look. We still mention that more conservative investors will want to take a pass here. So I recommend looking at this content. How do you factor in a company's debt load in your recommendations? Is there a debt load that you would avoid when buying a new stock? Yeah, we always look at a company's balance sheet before we recommend a company. And debt isn't necessarily a bad thing. For instance, I know American Express has a lot of debt relative to total capital, but that's part of their business, offering loans and credit cards. So each company is looked at individually. But yes, a large debt load can be problematic if a company is struggling and not able to make, interest payments, or they've got to pay the debt rather than fund, meaningful parts of their operations. I'm going to answer one more question, and then I have to run. But if you have additional questions, and I know I haven't gotten to all of them, please feel free to email me at igendler@valueline.com. That's the letter I, GENDLER@valueline.com. Next one is Boeing still in one of the model portfolios? Yes, it is in portfolio 4, and it has been a long-term holding. So it's still in there now. As I mentioned earlier, if you've been a shareholder for a while, you might want to ride this out. But as I mentioned, I wouldn't recommend new commitments at this time. All right, that's going to wrap it up. Thank you so much for all the questions and for participating today. Have a good day. Thanks so much.